$716,002. The portfolio added another 9,125 this week. That is a 1.3% gain in 4 trading days. Calmer than last week, by design. But one day in particular looked terrible on paper. We paid over $10,000 in realized losses just to close out 4 positions. And yet that single day quietly banked $7,455 of forward income. Welcome back to the lab. This is Trade of the Week, Episode 3, and today we run the math on the day the wheel got run over. The wheel kept doing wheel things. 46,000 shares of Marathon Digital produced $6,660 in net premium across 100 new short puts at the 9 strike and 140 new short calls between 10:50 and 12. SPY added another 4,885 in front spread credit and PMCC short calls. Coinbase and Bitmine were quiet this window. 3 positions, 2 active streams, 27 option trades total. Mechanical, repeatable, almost boring. That is exactly what you want from this layer of the portfolio. Before we get to the spotlight, here is what SPY did this week. We deployed roughly $17,000 of capital into 3 new long-dated calls. December 2026 710 strike, December 2026 705 strike, and March 2027 705 strike. 3 leaps anchors, 3 different expirations, building time diversification across the PMCC structure. We also rolled the front put spread into the May 22nd and May 29th cycles, collecting fresh credit. The SPY book is not one trade. It is a layered system designed to compound through any tape. The Mara put side ran a textbook profit cycle this week. April 20th and 21st, we closed 35 contracts of the May 8th, 850 strike, puts at 12 cents each. Booked roughly $2,300 of profit on those alone. Same days, opened 35 new contracts at the May 22nd, 9 strike. Higher strike, closer to current price, bigger credit. This is the patient side of the wheel. Sell low, buy back even lower, redeploy higher. No drama, no headlines, just a small grinder running every week. But the real story this week is the call side, and specifically what happened on April 17th. Marathon Digital ripped through 1150 by mid-morning. 4 of our short call positions, totaling 130 contracts, went deeply in the money. We had a decision to make. Take assignment, roll, or hold and bleed. We chose to roll on every single one. And the math behind that single hour of trading is the most important lesson in the entire wheel playbook. Pay attention. This is the trade that separates wheel operators from wheel collectors. Rolling up and out means closing an in-the-money short call at a loss and immediately opening a new short call at a higher strike with a longer expiration for a fresh credit. The point is not to escape the loss. The point is to keep the income engine running, raise the ceiling on assignment, and buy enough time for the position to settle. You are not avoiding the rally. You are repositioning to a strike that lets you keep collecting premium without locking in a forced sale at a price you do not want. Here are the 8 trades that made up the roll. Top half, the closes. 40 contracts of the April 17th 11 strike, paid back at 88 cents, and another 40 paid back at 63 cents. 20 contracts of the April 24th 11 strike, paid back at 110. 30 contracts of the May 1st 10.5 strike, paid back at 166. Bottom half, the new shorts. 80 contracts at the May 15th 12 strike. 30 at May 22nd 10.5. 20 at May 22nd 11.5. Higher strikes, longer durations, fresh premium. Now the math, line by line. To close the 4 losing shorts, we paid out $13,220 in cash. The realized loss on those closes was negative $10,475. To open the 4 new shorts, we collected $17,930 in fresh credit. Cash flow on the day was a positive $4,710. And total economic effect over the lifetime of the new shorts, assuming they expire worthless, is positive $7,455. The headline number was a loss. The reality was a meaningful gain. This is the part most retail traders get wrong. They look at the realized P and L column at the end of the day. They see negative 10,000. They feel terrible. They tell themselves the wheel is broken. But realized P and L is a backward-looking number. It is the past. The $17,930 in fresh credit is forward-looking. It is the future. To judge the day fairly, you have to net them. Negative 10,475 plus 17,930 equals positive 7,455. That is the day's true score. The other key word is up and out. Not just out. Strikes were lifted from the 11 and 10.5 range to the 11.5 and 12 range. Assignment ceiling raised by 50 cents to $1. Durations extended 4 to 5 weeks. The new shorts are no longer 90 delta in the money. They are roughly 30 to 40 delta out of the money. We bought back price space and we bought back time space. The new shorts have room to breathe. The old shorts had no room left at all. There is a decision tree here that you have to internalize. If the rally has further to run and you want to keep the income engine going, you roll up and out for a credit. If the rally is exhausted and you would be happy owning the stock at the new strike, you take assignment and start fresh. If the stock has stalled and you do not want to commit more capital, you can also roll laterally, same strike, longer DTE, for time decay alone. 3 options, one at a time, never panic. Why this matters? The wheel is not passive income. It is an active mechanical system that asks you to make exactly this decision every few weeks. People who treat it as buy and hold get steamrolled the first time the underlying rallies hard. People who treat it as a system simply run the math, execute the roll, and keep collecting. There is no skill in selling a put when nothing is moving. The skill shows up on days like April 17th. That is when the wheel earns its annualized yield. For takeaways and one management note. 1. And in the money short call does not mean you lost money. The stock you own is up more than the call cost. 2. When you roll, look at net premium across the full transaction, never the realized loss in isolation. 3. Roll up and out, never just out, so you buy both price space and time. 4. Do not roll forever. The wheel was always supposed to assign sometimes. Management note. We will profit take 50% on these new May shorts the moment Mara pulls back into the underlying. $716,002. Up 9,125 this week. 6,660 of that came from Mara will premium. Another 4,885 from SPY. The April 17th roll looked like a $10,000 loss in the moment, but it banked 7,000 for 155 of real economic value once you net the realized loss against the new credit. If you want to see how every roll, every spread, every PMCC plays out week by week, subscribe. We publish every trade with the real numbers attached. That is the trade. For closes, for opens, 1 hour, 7,000. For $155 of net economic gain on a day that looked like 10 grand of losses. The math hidden behind the headline P and L is where will operators actually live. Next week we are back with the portfolio update, the next roll, and the next ticket. Bring a notebook, bring your own numbers, and run the math alongside us. Until then, stop guessing. Start calculating. This is mathematical money.